Hello and welcome to the instructional video for the Daily Divergence Signal System, or DDSS for short. This video will help you learn how to trade signals generated by the DDSS. Once you've installed the software, open up your MetaTrader platform. I have a demo platform open here, and I'm going to open a chart on EURUSD. And chart opens on the 1 hour time frame, so I'm going to switch the time frame to daily. This system is designed to run on the daily time frame. Once you have the chart ready, it's time to load the template that gets installed. So I right click, and the template is named DDSS. There's also a DDSS custom indicator installed when the software is installed. The system is based on 3 indicators. We have a moving average, which is this blue line right here. We have price envelopes, which are these 2 dashed blue lines. This is basically a price channel. This is our upper channel, and this is our lower channel. And we have the DDSS custom indicator. This indicator is based on MACD histogram. This is not to be confused with the MACD indicator that comes with MetaTrader 4. If we take a quick look at that, here you see a histogram, but this is not a true MACD histogram. MACD generally has 2 moving average lines displayed and then a histogram. The histogram being the difference between the 2 moving average lines. For whatever reason, MetaQuotes decided to display one of the moving average lines as a histogram, and it doesn't even calculate a true MACD histogram. If you want to learn more about it, you can read the user document. It covers why we don't use the MACD that comes with MT4. If you haven't read the user document, I recommend taking a look at it after you finish watching this video, as it does contain some useful background information that will help you understand how this system works. Okay, you'll also notice that there are 3 horizontal lines on the chart. We have this red line, yellow, and green line. This is the take profit level, the stop loss to break even level, and the stop loss level for the last signal shown on the chart. So the last signal shown on the chart is right here. And that's a buy signal. Before I talk about trade signals, I'm going to talk a little bit about divergence and what is divergence. Close these windows down, get a little more screen space, and stop the chart from scrolling. Divergence is basically when price action is doing one thing and the indicator is doing something different. So for this particular entry signal, you'll see a downward sloping divergence line. Price is making lower lows. Now if we look at the MACD histogram, the histogram value are making higher lows. Okay, this tells us that the trend is weakening. There was a strong downtrend right here, and you can see some pretty strong red lines as the MACD is below 0. Okay, this shows us that we're in a downtrend, and the downtrend is pretty strong because we have some large lines. The market pushed up a little bit and then dropped back down. And you can see that the histogram lines are fairly small. So the strength of this trend is a lot less than this one, and that tells us that the overall downtrend is weakening. Now there are a few different types of divergence. This system is based on classic divergence. You may have heard some other types like hidden divergence, or peak trough divergence, or slant divergence. Those are divergences. However, their signals are not as reliable as true classic MACD divergence. And in order to have a true classic divergence, we need to see the MACD histogram crisscrossing this zero line. Okay, this is a bullish divergence. In order to have a bullish divergence, you need to see a red trough here. Then the MACD crosses zero and goes green, and then drops below zero and turns red. Okay, this action here some people refer to as breaking the back of the bear. Okay, we're in a downtrend, and now the bulls have taken control a little bit. It doesn't last long, and now the bears have taken control. But as can be seen, the prices are going lower, but their strength is a lot less than what it was before. And this is a signal that the trend is about to reverse. We take a look at a divergence in the other direction. This is a bearish divergence. Here you can see prices are making higher highs, but our MACD histogram is making lower highs. And this is known as a bearish divergence. And you can see we do have the prerequisite crossing of the zero line. It's actually happened twice. Now, a lot of people would not consider this divergence because they'll only look right here where we had one crisscross. But this is still a divergent situation. The MACD is pretty high right here, and it's still decreasing. And as it turns out, this is a pretty good signal because price went straight down. You will sometimes see 3 or 4 red sections and then 5 green sections that are decreasing. That's still divergence. As long as the MACD histogram is decreasing and the price is increasing, we're in a divergent situation, even if there may be some other crisscrossing of the line multiple times here. And the indicator will take care of drawing the lines for you when that happens. Sometimes divergence will be canceled when subsequent price action and MACD histogram movement makes the divergent situation no longer true. So if we take a look at this green dashed line, we did have a divergent situation occur when we had a lower low and then a higher low on the MACD histogram. A couple of bars later, the MACD histogram went lower and actually went below the level of this low right here. So we did have divergence at first, but then the subsequent price action canceled it. And what the indicator will do is make the line dashed, and you will not see a trade arrow signal as divergence has been canceled. There's also an example of this near the edge of the chart. You can see it happening better. Here we are in a downtrend. The MACD crossed the zero line and then crossed back down below. Now price is making lower lows, but the MACD histogram was making higher lows. And that was true for each new candle. Eventually, the price fell far enough to drive the MACD value lower than the previous low value. And so MACD divergence was canceled, and there will be no arrow generated here as our low MACD value is now lower than this low MACD value. Alright, I'll show you one more thing before looking at a trade signal. Right here we have our entry signal. You can receive alerts when divergence lines and entry signals appear on the chart. So we'll go into our DDSS indicator, and down here we have our notification settings. If you want it to be alerted when a divergence line appears on the chart, we have three different types of alerts. We have a chart pop-up, which is this divergence alert. There's an email alert, and there's a push notification to your smartphone alert. If you want to be alerted when there's an entry signal or a new arrow appears on the chart, we can be alerted on the chart, email, or a push notification. And you can customize these to however it is you're going to use the system. One good thing about running on daily is you only have to check it once a day to see if a new signal's been generated. You don't have to keep running back and forth or checking your smartphone every 10 minutes to see if we have new signals. Signals are generated on the candle close only. So you really only need to check once a day for a new signal. Alright, let's start looking at some trading signals and how we would trade those signals. We'll take a look at this one right here since we already have our take profit and stop loss and break even line on the chart. Zoom in a little bit here. Okay, so the signal was generated. In order to make an entry, we need to have four conditions true. And I'm going to refer to the user guide as it lists what four conditions. We need to first identify a divergence. This is done for us with the lines that are drawn on the chart. Then we need to wait for MACD histogram to start moving in the opposite direction. So if we look down here, we have our divergence line, and now MACD histogram, which was decreasing, has started to increasing. So the bright red histogram lines now turn to dark red. These two are taken care of for you. The lines are drawn on the chart and the arrow is drawn on the chart when the histogram starts moving in the opposite direction. Step number 3 then is to adjust the price envelopes at 90 to 95% of the candles reside within those envelopes. So let's adjust our chart here. So this is the chart. This is what the chart looks like when we get our entry signal. And if you take a look at the candles, most of them are within the price channel. You've got a few that the price extremes either touch the line or go just outside the line. We want to see 90 to 95% of the candles within the channel and 5 to 10% of the candles just touching beyond the price channel. So this looks pretty good. We don't need to make an adjustment here. Now that step 3 is completed, we move on to step number 4, and that's calculate the risk reward. So I'm going to use the crosshair tool to help calculate the risk reward. The entry is right here where the candle closes. I'm going to use the crosshair and drag it down to the stop loss line. It's looking right around 90 pips risk. Now I'm going to drag it to the take profit, and that's looking 182 pips. So we're looking right at a 2-to-1 reward to risk ratio, so that's acceptable. So we're going to take this trade. Now let me zoom in real quick and show something really quick. You may not be at your computer when the signals appear. So you may be doing something else and you check the computer 2, 3, 4 hours after a signal. It's still okay to enter as long as the price hasn't started moving towards the take profit. So the entry signal is generated right here at the open of this candle. And price moved down a little bit. If you were to come to your computer, see this signal and see price has dropped below the entry, it's okay to enter. Now if you miss the signal and price has moved towards the take profit, you don't want to chase the market. So you would stay out, and if price was to come back, you could get back in if it reached the entry point. But one thing to remember is to never chase the market, because you're just increasing your risk when you do that. And we want to keep a very nice risk to reward ratio when trading this system. Okay, so we took the entry. The first thing we need to do is to place a take profit onto the actual order. Let me pull up the terminal window. I've got a demo trade here. This is not this signal, but just a trade that's running from someplace else. And the first thing you want to do is to set your take profit. So our take profit level is 1.37205. And if I right click and modify the order, this will be 0. But as you can see, I've already set the take profit to 1.37205. The stop loss I'm going to leave at 0. We're not going to put a hard stop on this particular order. And there's a reason for doing that. As you trade the system, you will notice happening on many occasions, price will start working against you. This is a reversal system, so price does work against you. And it can come down and it may get below this red line. However, it may come back up and then close above the red line. We only want to close when the price actually closes below the red line. So you will see trades that sometimes come down and bounce around, and you'll see the shadows of the candles down here, but the close is up here, and then price will reverse. So it's important not to put the stop loss on the order so we don't stop out too early. We only want to stop out when we get a close below the stop loss line. Now in this particular example, we can see that price started moving in our favor right away and eventually made it to the yellow stop loss to break even line. At this point, we're managing our risk here, and what we're going to do is set a hard stop to break even. So once you see price touch this line, we want to go in and modify our stop loss on our order. So and we're going to set this value equal to our entry price. So our entry price was 1.31976. It's okay to add a couple of pips here. That way, if the market was to reverse and come back down, we would stop out with at least a couple of pips profit. You don't want to get too carried away by adding too much profit here, because the market does need some room to move. So I would limit it to just adding a few pips at most. And that way, if price was to retreat, then at least we get a couple of pips out of the trade. It wouldn't let me do it there because it was an invalid price. But that's what you want to do once the price hits this yellow line. Now this yellow line by default sits at 50% between the entry and the take profit. You can change this down in the DDSS indicator. There's a stop loss to break even percent. Default's 50. Say you wanted to make it 75%. You wanted the market to move a little bit further before you set the stop loss to break even or locked in a little bit of profit. So we just change that to 75. And now we have a new level here for setting a stop loss to break even. So the trade would have had to work another week or so, and eventually you'd be at stop loss to break even. Now if we look at what happened, the price did reverse. Then it went sideways for a little while, and eventually it came down to our entry point, and we stopped out at break even. So this trade was a break even trade if we followed the rules to the letter and let the price action do what it did. Now there are situations where you're nearing to take profit and you may want to get out before actually hitting it. If we take a look at this trade, we set the stop loss to break even, got fairly close to the take profit, then price came back, then price started moving up again, but then price started moving sideways. If we look at our MACD histogram, we can see there was no real clear trend. The trend was up, then it was down, it was up, it was down, but the trend was bouncing around, so you may lose confidence at this point that price is going to make it up to here. So it's okay to take profit even though we haven't reached the top level. We're probably looking at 80 pips or so. But somewhere around here, 84 pips. You could have closed the trade there because it was clear by the indicator that there was no clear uptrend, and the trend kept switching between uptrend, downtrend, uptrend, downtrend. So you can take the profit there. Alright, now let's take a look at a trade example for a sell. Let me take this line off the chart. And right here we have a sell signal. The arrow is a little bit above. There we go. We have price making higher highs while MACD is making lower highs. And we get a sell signal. Now there's 4 steps to go through. The first 2 steps have been taken care for us here. But now we can see that the price closed below the moving average. We can tell right away that we're not going to have a risk reward. These price envelopes are equidistant from the moving average. So the number of pips from the moving average to the upper envelope is the same as the number of pips from the moving average to the lower envelope. And when price closes below the moving average, we have less than 1-to-1 reward to risk. So we're not going to take that trade. It just happened to work out here. As you can see, price came down and within 3 days, well, these aren't the right lines. Let me remove those lines from the chart. Those are the lines from the last signal on the chart, which was that green one right there. So I'm going to not show those lines. Assuming these envelopes were valid, the take profit would be right down around here, and you can see price within 3 days got down to that level. So that trade worked out, but we didn't take it because our reward to risk wasn't good enough. And you want to stick to the rules, because when you start doing stuff like this, the stop losses get bigger, and if the trade works against you, you're losing more than you really should, and that hurts your bottom line in the long run. So we laid off that signal. We didn't know it was going to work, but it just happened to work. Go back here. All right. Again, here we have a sell signal. Similar situation. It closes below the moving average, so we know right away it's less than 1-to-1 reward to risk, so we don't take it. Here we have a good signal. So let's pull up our rules once again. So again, the indicator takes care of the first 2 for you. We've identified a divergence. the MACD histogram has started moving in the opposite direction. Now we need to adjust our envelopes and calculate the reward to risk. So at the time of the signal, the chart looked like this. And you can see the envelopes are too tight. There's too many bars going beyond the envelopes, and they're going too far beyond it. So we're going to make the adjustment. So we get into our properties, and we adjust at the deviation. The deviation is basically a percentage from the moving average. So this is saying that the envelope should be drawn 1% from the moving average. So the envelope above will be 1% higher than this value, and the envelope below will be 1% lower than this value. When we want to make the channel wider, we increase this number. So let's put it at 1.75%. Now we take a look at it, and we're looking, and this actually looks pretty good. I think it's a little too wide. There's not enough bars getting outside, so we're going to tighten that up just a little bit. And we want to tighten it up. We make the number smaller. So we'll go 1.5%. Now we got a little more bars getting beyond. So we're looking pretty good right here. Now the indicator will handle drawing the lines for you, but if you change the envelope's indicator here on a chart, you need to change the values in the DDSS. So we set it to 1.5. We need to set this to 1.5. Then the lines will be drawn at the proper values. Now it's not going to draw lines for this example because it only draws lines for the last signal on the chart. But you can manually put the lines on here based on the envelope. So look here, put a line up here. Let's get our signal line right here. You want this line to be right where the lines intersect. And this is a stop loss line, so we'll make it red. Again, this will be here for you if this is the last signal. And our take profit line be right there. And that line would be green. I'm not going to add the yellow line. We'll just do this to calculate risk reward. Come on. And we'll make this green. Okay, so there's our trade signal. Now we calculate the risk reward, or reward to risk, however you refer to it. The candle closed right here. We trace to the stop loss, and that's about 79 pips. We then trace it to the take profit. That's 331 pips. That is an excellent risk reward. You're almost 5 to 1 there, and that is a great signal to take. If we look at what happened with the trade, it moved in our favor right away. So this signal was an excellent signal as the trend reversed immediately. And within 1, 2, 3, 4, 5 days, we had about 315 pips. And those are the types of trades that can happen with the system. We need to stay disciplined in our trading and only take these signals when we get the adequate risk reward. Because that's the only way you're going to be long-term profitable trading is stick to your plan, make sure you're using good risk to rewards. Now when there's a manual system such as this, or an expert advisor, an automated system, people will always ask, what pairs can I trade it on? And the only way to answer that question with this system is to drop the template on the chart of the pair you're looking at. So let's just look at a random pair here. Let's look at this one. Aussie dollar, Japanese yen. Alright. So we have the chart, we move to the daily time frame, and now we load our template. And what you would do at this point, turn off the auto scroll, is look back through the chart at the signals. And here you can see we had a sell signal, probably wasn't taken because it's below the moving average, but the price did move down after that. Here we have a buy. Looks like a decent signal. I'm not going to adjust the envelopes, but what you would do when testing out a pair is move the signal over to the right edge, then adjust your envelopes, and then calculate your risk reward to see if you would have taken the trade. You'll be able to do this visually pretty much using the moving average. If the price is above the moving average on a buy, you're not going to take it. If it's close to the moving average, you're not going to take it. You know, when it's this far, you're probably talking 1 to 5, 1.5 to 1 reward to risk. As you gain more confidence, that will be acceptable to trade that reward to risk level. When you start out, you should start out at 2 to 1 minimum. But as you gain more confidence, you can go down to 1.5 to 1. But you always want to make sure that your reward is greater than your risk. Then we had a sell here and price went down. So, you know, for this particular pair, again, you would scroll through looking. We had a couple of sell signals in a row. What probably happened here was we got in here. The stop loss was up here somewhere. Probably got the signal and was still in this trade, so we would not get in a second one. And it would have been close as to whether this actually closed outside the proper envelope level. It may have closed, and then we might have gotten another signal right away. And in the case of that, where you take a loss and then you get another signal immediately after it, you should trade this signal. Now, this particular one we wouldn't have taken because our risk reward wasn't good enough. You can see that price closed right on the moving average, so our risk reward was 1 to 1. But with this particular system, the trend is still weakening, and we're looking for a reversal. And it didn't happen here, and we might have closed out right here. You know, the envelope line might have been right here, and we got to close, and we took the loss. If we got a valid signal and our risk reward was good enough, we would go right back in. Because you'll see a lot where you'll get a couple of arrows, the trade may stop out, then we get another signal and it makes a big move in the opposite direction, and the trend indeed does reverse. So again, you need to gain some experience, look through some charts, and that's how you tell if this system is going to be good on that particular pair or not. So that's the end of this demonstration. Again, a couple of key things to remember. Always make sure you have a good reward to risk ratio. Don't trade trades that are less than 1 to 1 risk reward. You want to stick 1.5 to 1 at worst. Alright. Also remember that if you are adjusting the envelopes so that the prices fit in properly, if you make an adjustment to the envelope deviation, make sure you make the same adjustment down in the DDSS indicator. That way the lines will be drawn properly on the chart. But this system works well on daily. Test out as many pairs as you want. You only get 5, 6, 7 trades a year per pair, but you can trade this on many pair. And the pair you trade it on is all based on you looking through charts and determining whether or not that pair will work with this system. But good luck and happy trading.